Ladies and gentlemen, what happened in the last 48 hours in the gold and silver market is something that every single person watching this channel needs to understand right now, because the mainstream media is telling you a story, and the physical market is telling you the exact opposite story. And in a few minutes, I'm going to show you with verifiable data which one is telling the truth. Before we go any further, hit subscribe right now. Smash that like button. Drop a comment so I know you are locked in. I will never ask for your money. Never pitch paid signals or investment courses. Protect your capital and stay away from scams using my name. Now, let us get into it. Here is the headline narrative as of this morning, May 22nd, 2026. Peace deal with Iran is falling apart. Oil is back above $100. Inflation is sticky. The Federal Reserve might hike rates. Silver is down 39% from its all-time high. The bubble burst. The smart money got out. That is what every financial television anchor will tell you today with complete confidence and zero accountability. Here is what is actually happening. Silver is trading at approximately $74 to $76 this morning. That is still 122% higher than it was exactly 1 year ago. Gold is sitting at $4,524 per ounce, still 34% above where it was 12 months ago. And the physical market for silver, the real-world market where actual metal changes hands, is telling a story so different from the paper price that the gap between them has become almost impossible to explain away. Let me show you exactly what happened this week, because the sequence of events matters. On Tuesday, May 20th, something changed in the diplomatic picture. President Trump said the war with Iran would end very quickly. Vice President Vance talked about progress in talks. The headlines were optimistic. Oil fell 3 sessions in a row. Silver jumped back above $78. Everyone breathed. The peace trade was back on. Then came Thursday. Iran's supreme leader, Ayatollah Mojtaba Khamenei, issued a directive. 3 words in practical meaning. Iran's near-weapons-grade uranium stays in Iran. It does not leave. Not for any deal. Not for any framework the Americans have proposed. Israeli officials had said uranium transfer was a non-negotiable condition. The supreme leader just told them that condition is dead. Brent crude immediately jumped 1.9% in the Asian session to $104.52 a barrel. West Texas Intermediate climbed 1.5% back to $97.81. And just like that, the peace trade that gave silver 4 days of recovery was gone. The Strait of Hormuz, through which approximately 20% of the world's traded oil moved before February 28th when this conflict began, is still closed, and as of this morning, the path to reopening it just got significantly longer. Now, here is what the mainstream narrative completely misses. While this geopolitical drama has been playing out on the surface, something has been happening underneath it for 6 consecutive years that no single peace deal or rate decision can reverse. And that is the physical silver market draining itself dry. Let me show you the numbers. Every one of these is independently verifiable. The Silver Institute, the industry's own research authority, published its World Silver Survey on April 15th of this year. Their conclusion in plain language: silver has clearly entered an era of reduced stocks. Not my words, the industry's words. Since 2021, 762 million ounces of silver have been pulled from above-ground global stockpiles. That is 9 months of total global mine production. Consumed, gone, into solar panels, medical devices, AI server infrastructure, electric vehicle components, not coming back. And the 2026 projected deficit is 46.3 million ounces. The 6th consecutive year the world uses more silver than it produces. 6 years in a row. Not a blip. Not a temporary imbalance. A structural depletion that has been compounding since 2021 without a single year of improvement. Now, let me show you what China is doing. because this is the part that should genuinely stop you cold. According to Chinese customs data reported by Reuters, China imported 836 metric tons of physical silver in March of 2026 alone. 1 month, 836 metric tons. That number represents approximately 173% above the 10-year seasonal average for March. That is not a trading position. That is a country-level decision to acquire as much physical metal as possible before something changes. And here is what has already changed. Since January 1, 2026, China has classified silver as a strategic material and restricted exports to government-authorized companies only. They are not selling silver out. They are buying it in. Every ounce going into China is not coming back out on your terms. That metal is gone from the Western market. The Shanghai Futures Exchange is showing silver trading at a premium of 12 to 17% above international benchmark prices right now. In normal markets, that spread disappears in hours. Traders buy cheap in New York, ship to Shanghai, pocket the difference. Textbook arbitrage. It is not closing. You know why? Because the metal that would normally make that trade physically cannot leave the system in sufficient volume. Export restrictions, tightening inventory, refinery constraints. The arbitrage is broken, and when arbitrage breaks, it means the two markets are no longer pricing the same physical reality. One market has the metal, the other market has the paper. Now look at the COMEX, the commodity exchange where silver futures trade in New York. The registered inventory, meaning the metal with warehouse warrants actually available for immediate delivery against futures contracts, stands right now with a coverage ratio of 16.2%. Paper leverage running at 6.2 times deliverable supply. And the June 2026 first notice day is 6 business days away with approximately 14.5 million ounces still open in contracts. Let me put that in plain language. There are paper claims on silver that are 6.2 times larger than the metal available to honor them. And the date when those contracts come due for physical settlement is 6 business days away. In January of this year, in a single week, 33.45 million ounces were physically withdrawn from COMEX registered inventory. 26% of the entire deliverable pool gone in 7 days. That event is in the public record. You can look it up on the CME Group website right now. When that happens again, and the coverage ratio is already at 16.2% heading into a June delivery cycle with $14.5 million ounces outstanding, what do you think the paper price does? Now let me tell you about something the financial press buried this week while covering the uranium directive. The U.S. Mint already raised the price of the 2026 Silver Eagle Proof coin to $173. The 2025 edition sold for $95. That is an 82% price increase year over year. Official government mint of the United States. 82% more expensive than last year, because the silver inside it is 82% more valuable. But the television is telling you the bull market is over. The 2026 Silver Eagle bullion release was delayed from January to February because of production and pricing complications during the January price spike. The Proof coin subscription sold out before the public had a chance to respond, and dealer premiums on bullion Silver Eagles, the basic 1-ounce coin, remain elevated above spot in a market where the paper price has come down 39% from the January peak. Go verify that yourself right now. Pull up any bullion dealer website. Look at what they are charging versus what the futures screen says silver is worth. That gap is the physical market talking. The paper market is the story. The physical premium is the truth. Now here is where I want to address the bears directly, because intellectual honesty requires it. The Federal Reserve is not on your side right now if you are holding silver. The FOMC minutes released this week confirmed that a majority of policymakers believe additional rate hikes could be necessary if inflation stays above 2%. Markets are pricing a 50% probability of a December rate hike and have completely abandoned any expectation of cuts this year. Kevin Warsh, the new Fed chair confirmed by the Senate 54-45 on May 13th, the slimmest confirmation margin in the institution's history, is a hawk. He opposed quantitative easing when he was on the board the first time. He called publicly for regime change at the central bank. The most prominent monetary hawk in recent Fed history now runs the institution, and his first meeting is June 16th. A hawkish Federal Reserve is a headwind for silver. Period. The paper market prices silver against real interest rates. When rates go up, the cost of holding a non-yielding asset goes up with them. That is not opinion. That is arithmetic. The 10.5% single-day crash on May 15th happened for exactly that reason. Photovoltaic silver demand is also falling. Solar manufacturers are reducing the silver content per panel. Longi Green Energy is shipping copper paste alternatives. ICO Solar is deploying silver-free cells in commercial volume. The solar demand story that drove silver to $121 in January is being partially eroded by engineering substitution. India doubled its import tariff on gold and silver from 6% to 15% on May 13th. India is one of the largest physical bullion markets on Earth. A tariff that doubles the effective cost of bringing silver into the country is a direct demand hit to a pool that was already absorbing paper side selling pressure. These are real headwinds. Anyone telling you they do not exist is not doing analysis. They are selling you a narrative. But here is what the bears cannot explain. If this is a burst bubble, why is silver still 122% higher than it was a year ago? If the smart money got out, why did China import 836 metric tons in a single month at prices above $80 per ounce? If demand collapsed, why does the U.S. Mint's proof coin now cost $173 when it cost $95 12 months ago? If the supply deficit resolved itself, where are the 762 million ounces that have been pulled from above-ground stocks since 2021? The paper price corrected. The physical reality did not change by a single ounce. And there is one more supply story that nobody in mainstream financial media has properly priced yet. Peru, the second largest silver-producing nation on Earth, responsible for approximately 13.6% of global mine output. Peru issued a formal national energy emergency decree in the second week of May, citing tightening domestic energy supply with direct operational impact across mining, mineral processing, and logistics. That decree is not resolved. The output data from Peru that shows up in global supply numbers will not appear for weeks. By the time the market reads that data, the adjustment has already happened in the physical market at prices that are not visible on the futures screen today. Supply disruptions do not file press releases. They appear in the data after the fact. And by then, the window to act at current prices has already closed. Now let me show you what happens next. 3 scenarios, and I will be straight about the probability of each one. And watch the dollar. Not because the dollar tells you about silver fundamentals, because the paper market for silver is priced in dollars. A weaker dollar is a mechanical tailwind for the paper price regardless of what is happening in the vault. The Bank of Japan intervened on May 2nd to weaken the dollar. If the dollar-yen rate pushes back toward 160 pressure levels, Japan acts again. 2 rounds of BOJ intervention in a tight window is the mechanical fuel for a silver recovery attempt above $80 that has nothing to do with Iran or Kevin Warsh. Here is the bottom line. Silver at $74 to $76 this morning is still 122% above where it was a year ago. The physical market that pushed it to $121.64 on January 29th has not reversed. The vaults have not refilled. The structural deficit is in its 6th consecutive year. China is importing at record pace. The U.S. Mint's silver-proof coin costs 82% more than it did in 2025. Peru's energy emergency is feeding through supply data that has not yet hit the tape. The paper market corrected. The physical truth did not. Those are not the same event, no matter how many times the television tells you they are. Go verify every number I just gave you. The CME Warehouse Report, the Silver Institute World Silver Survey, the Chinese customs data on Reuters, the U.S. Mint pricing page, the Shanghai Futures Exchange premium data. Pull all of it yourself. Make your decisions based on evidence, not on what a man in a good suit is telling you between pharmaceutical advertisements. The gap between the paper price and the physical reality is the only number in this market that matters right now. And that gap has been widening for 6 consecutive years. Subscribe if you want me to track the June delivery cycle in real time and signal when the registered pool data starts moving in the direction that forces the paper market's hand. Hit that like button if this breakdown showed you something the mainstream narrative buried. Drop a comment with one word, physical or paper. Tell me which market you believe. This is your capital. This is your future. This is your responsibility. The screen says one thing. The empty vaults say another. Invest with logic, not hype. I will see you in the next one.